Hey everyone, this is Logan Hertz with Hazeltine LLC, and we are continuing our series of interviews with financial professionals in the industry with a lot more experience and knowledge than me. And today we have with us Anthony Rushing, who is one of the premier thought leaders, experts, subject matter experts on the First Lien HELOC product and related velocity banking strategy, sometimes called the maximize cash flow strategy. And we're excited to have him with us on the program today. Anthony, how you doing?
I'm good, Logan. I'm good. Thank you for the intro. I think I should maybe I can have you introduce me for all these kind of things if you're going to do me that much justice. That's awesome. Thank you. I really appreciate you having me on. I'm excited to chat with you and kind of share what I've learned, if that makes sense. Hopefully it can provide some value to anyone that's out there listening. So I'm excited to chat with you. Thank you.
So Anthony is an expert and a specialist in the first lien HELOC. Of course, I love it. I believe in it. I know enough to be dangerous. I'm an ambassador for the program, so I help my clients with it where it makes sense. And but I don't pretend to be the world's foremost expert on it. That's why I bring in someone like Anthony. And I think Anthony, in the interest of full disclosure and compliance, I think you have a
Yeah,
few
so
things
there are a few
you
things
need to disclose. So go ahead.
I just
Yeah,
have to
go ahead.
say I am a loan originator, I'm the sales team leader at the First and HELOC branch at First Savings Bank. My NMLS number is 1599345. Any opinions or things that I share do not represent the bank. So they represent what I believe and don't represent First Savings Bank as an entity. So now that we got that out of the way, I'm excited, to share, right, and to talk with you a little bit about this product and what it can do and the way that people are using it to improve their lives.
Yeah, so I always like to start with why. Like, why did you why how did you end up in your current position?
So this may be longer than what you had anticipated or hoped for,
Okay,
but I kind of
go
like
ahead.
to go back.
Story time.
Not, yeah, not to the beginning, but to provide a little history about my progression, because I've got a myriad of different experiences. So when I went to college, I joined this rock band and then quit halfway through, and we saw a fair amount of success, and um, we had a bus and we got signed and we went on, we had tours for about 6 years. It was great. I got to open for some really neat people, but there was this question I always had, which I couldn't recognize the value, and not that it didn't happen, but I couldn't directly see the value that I was bringing to people, right, to the world, right. And the thing is, musicians do. I just couldn't see it. It wasn't tangible for me, so it was challenging. So ended up leaving, went back to school, got into real estate investment for a little bit, and then learned about this program called Teach for America, which is a nonprofit that provides basically human capital teachers um, to low performing schools, but also to high needs schools as well. And so the idea is that they sort of supercharge these recent college grads to be extremely effective teachers. And so, my first year, my class outperformed the other kindergarten teachers that were there. I was a kindergarten teacher my first year.
Oh
Then I went
wow,
into third
congratulations.
grade math.
Congratulations.
And part of third grade, part of being a teacher in that age group is creating structures visually that represent what's happening with the mathematics. And so I got to sort of train myself with that. And I was going to become a principal, right? I got my master's in education leadership and at LSU, and then continued that direction. Had twins with my wife, and then we moved to Nashville, and it was tough, and the financial realities of being a father and being a dad. I was never a big gender role guy, right? But I found once I became a dad, that the financial realities of what I wanted to do with the family were not within reach in terms of being in education. And so I made the choice. I was playing in a bluegrass band at this time. So the mandolin player, he was a mortgage loan originator doing retail mortgages, and I was sort of sharing. I was a little burned out at that point, and then also the financial piece. So he's like, "Look, I'll teach you the business. Come on." So I hopped on with him, and it was hard. It was really hard. I remember when I made the transition, my best friend called and said, Anthony, you got to know this. You know, the satisfaction that you get from knowing that your work gets to help people's lives. I said, yes, I do. He said, with teaching, right? He said, you can, you know, we were good at tracking data and tracking growth. So I knew exactly how much my kids grew from year to year. We're talking 1.5 to 2 years worth of growth in a year. And so I knew that my work was helping people directly from the education piece. Well, he called and said, look, you're not going to see that in the mortgage world. Like it's either going to be really hard to see, or it's going to be, or you're going to have to really look for it because it's going to be completely different. And he knew me well, right? Because that's what drives me, right? That's what knowing that my work gets to improve other people's lives is what helps, right? So I kind of, I did have to search for that, and it was really hard and sometimes impossible for me to see that. But then the financial side of things, financial opportunity from the lending side, from a family security standpoint, was the driver, which doesn't align with how I work, but it also was a reality of my life at that point. So did that for a few years, and then I meet my boss now, who learned about this first lien HELOC product, and he introduced it to me. He wasn't with our company at that point, but introduced and taught me about it. And I was completely blown away because I'd never heard of this thing before, this financial vehicle before. I had never seen how people can use it, right? And I learned about this thing where people, when it works for them, right, are able to pay off their homes really fast and save a lot of money and keep money in their own pockets. And I was like, this is crazy. And he called me probably 4 or 5 months later. He said, hey, look, I think I found a bank, and I'm going to build a product there. He's like, do you want to come on? It's going to feel like a startup for a little bit because it's a new concept, and you know, we're starting from scratch. But do you want to hop on? And I was like, yes, I do. This is what I want to do, because I feel like a lot of the experiences I've had previously have built specific skill sets for me to succeed with this particular type of role, right? Because it's really an advocacy and an education role. And I teach people about math, which is what I've done before, right? And so hopefully I'm good at that. But that being said, and it also lines up with who I am, I believe, as a person, which is I want to know that I can help people. I want to see it, right? And so maybe I'm shallow, or you know, maybe I'm not deep enough to know, you know, otherwise. But I know how I work, and so that's kind of what drives me. So it's this really cool, amazing alignment between a lot of the things that I think I've built up throughout the years, and it also aligns with who I am and what I want to achieve from a overall life standpoint. So that's how I got here.
So with that, let's segue into the first lien HELOC. What is the first lien HELOC, and
Yep.
why would anyone want this product over a conventional mortgage? The first lien HELOC is intended to be a replacement
Correct.
for a conventional
Right.
mortgage, right? Not so when people hear HELOC, that's a home equity line of credit. We're not talking about your standard home equity line of credit, which is typically in second position on
Correct.
top of your first mortgage. We're talking about replacing your mortgage or buying a house with a first lien HELOC instead of a conventional mortgage.
Right. So the distinguishing between a first and second is important, right? This is not an extension of credit on top of your mortgage, like you said. This comes in and pays off your mortgage. So you get this monster line of credit and the balance is your previous mortgage if you don't pay anything else off. So yeah, why would someone else want it, right? Well, that is a great question, right? Because the amortized mortgage is what everybody has, right? And it's the industry standard. And because it's the industry standard, we're going to trust the industry, and therefore it must be the best, right? Well, I hope you get that, right? But here's the thing. It's all in all, it's just another kind of home loan, right? It's available. It follows different rules than an amortized mortgage does, right? By itself, the fact that, you know, that it's a tool that's open-ended, right? You fund your house and money can go in and money can come out, right? That's one main difference. It calculates the interest differently as well. It uses what's called the average daily principal balance to calculate your interest rate, which can be leveraged as well, right? So the reality is it's a home loan that follows different rules than an amortized mortgage does. And when you use this loan, when you maximize the benefit of this particular structure, right, for the right person, you can achieve outcomes that are better than with an amortized mortgage can, right? And so it's really that simple. It's no more complicated than it just works differently than a mortgage. And for some people, when you leverage how it works, you can get better outcomes. And so the reason why people would choose it is when it works, they can pay off their home really, really fast, right? Forget 30, forget 15. I mean, we're talking when it works, people have the ability to aggressively pay off their home. The catchphrase that everyone, 5 to 7 years, that's what you say, right? Because that turns heads, right? But in terms of the outcome that you can achieve is you can pay off your home really fast. Well, if you're paying off your home really quickly, you're only paying interest for a short period of time, you can save gobs and gobs of money and interest costs as well, right? And so the reason why someone would choose it is to pay off their home really fast and save money. I mean, that's the reason why. And so what we do is we teach people how to leverage the product. The product itself isn't the special thing. The thing that's special, the thing that makes it amazing, so valuable, is the way that you leverage it and understanding how that works and finding out and learning, right, with my particular scenario, is the outcome going to be great, right? Or will the outcome be bad? Because just like with an amortized mortgage, you could choose an amortized mortgage that doesn't work. This isn't dependent on the loan. This is dependent on the household, which we can get into more in a little bit. But in terms of why someone would choose it, is that if it can improve your life drastically, it makes sense to choose the thing that's going to do that over something that's going to help your life a little bit. Or, I mean, I could say that the amortized mortgage is not a very good vehicle for certain purposes. But yeah, that's really why.
Right. And I like that you made the distinction between the vehicle and the strategy. So the first lien HELOC is a product, it's a tool, and there's more to it than just that, like the checking account. There are a couple of things. We don't have to get into all the details, but the strategy that we use to best leverage the first lien HELOC is something that's known as velocity banking.
Yep.
And so you want to give us a little more color on how do we best leverage this great tool?
Yeah, I love the fact you use the word leverage, right? If we even if you think about simple tools, right? Like a hammer or a lever, right? You're leveraging what the tool can do. That's really what we're doing here. It seems more complex because we're talking about a financial vehicle, but it's no different than using a hammer to get a nail in, a nail in. It's just you just need to know how to use it. And so what we have to understand first is, if we're going to leverage the differences here, how is this different, right? What things are we leveraging, right? So there are two main differences with this particular product that the strategy leverages. One has to do with money flow, right? So with an amortized mortgage, it's called a closed-ended loan. So money can flow into your amortized mortgage, but it's locked away. You can't take the money back out, right? So you can pay down your mortgage as much as you want. You overpay, but you can never take it back out unless you get a cash out refinance, but then that's a cash out refi. The second difference has to do with the interest calculation. So in terms of money flow, right? Amortized mortgage money can only flow in. With a first lien HELOC, it's called an open-ended loan. So money flow wise, money can flow in and it can flow out freely. So you can, every dollar you put into the first lien HELOC, you can take back out, which means you can safely put as little, you can safely put as much. You can safely take everything that you have and put it into the first lien HELOC. And you can do that safely because if you need it, you can take it back out, right? That's a core understanding that we have to know and remember, because that makes the whole strategy feasible, we'll call it. The second difference has to do with interest calculation. So the way that amortized mortgages calculate their interest is they look at you got your calendar, it looks at the previous month's end balance on that date, and it uses that balance against your rate to calculate your payment. And that's just what it does, right? First lien HELOC, the right first lien HELOC. I don't know if they all work like this, but if you want to leverage the strategy, it needs to work like this. It will use what's called the average daily principal balance. So it'll use the average daily principal balance against your rate to calculate your payment. So if you want the lowest payment, you have to create the lowest average balance for that month. So if we think about how averages work, you got to, this is kind of how I see it in my head, like you got a bunch of days in the month, right? And if you want the lowest average balance between all these days, you create the most number of days with the lowest balance, and that creates the lowest average. Well, that starts on the very first day, creating the lowest balance as fast as possible, because that creates the lowest, that starts that track of creating the lowest average balance, right? So that's the whole key. That's the whole secret here. There's the curtain reveal, right? Create the lowest balance as fast as you possibly can, right? So how do we do that? Anytime you get income, it goes into the HELOC as fast as you can, and all of it goes there, right? That's the first part of what you do here, right? We create the lowest balance as fast as possible, right? So all of our money goes in the first lien HELOC. Well, that sounds crazy, crazy to most people, because if you did that with your amortized mortgage, your money's locked away, and now you got to eat food, you got to pay for stuff, right? And you can't do that because with an amortized mortgage, the loan that everyone else believes to be the only thing that's out there, right? If you were to do that, your money's locked away and you can't take it back out. Well, remember, money flow wise, with a first lien HELOC, money can flow in and out freely. So you just take the money back out to pay for your stuff, right? And that increases your balance. You pay for everything with your first lien HELOC. So if we think about like 1 month's viewpoint, you've got your balance, drive in all your income, that pays down your balance as much as possible. That's your principal payment. Nothing else pays down the loan. Well, it's your everything, so it's like your everything pays down the loan, but that's the only thing that ever pays down the loan. So then you pull from it to pay your bills, and that increases your balance. So at the end of the month, whatever money from your income you haven't taken out is simply still in the HELOC. Well, month over month, that's what pays off your home. So the only thing that will ever pay off your home with this strategy are the dollars from the income that is not spent, right? Now, I can spin that in a way that sounds better for my cause, right? That also means that every single dollar by default is dedicated toward paying down your home, which means there's no faster way to pay down debt because everything is there. Everything you have is dedicated to this. So there's no money anywhere else that you can funnel in here because it's all in here already. So there's no faster way to pay off the house. That's it. I mean, it's simplified. It's money goes in, all your income goes in, you take the money out to pay for your stuff, and whatever's left in there is what pays down your house. I mean, it's no more complicated than that. It doesn't have to be.
Right. And I think one of the most important elements to your product is that you automate the process, because there is a checking account that is automatically linked to your first lien HELOC.
Right.
So your paycheck comes in, it gets automatically applied to your HELOC balance. Then you make withdrawals to pay the bills, and it comes out of your HELOC balance. So you are not consciously changing anything about what you're doing. All you're doing is replacing checking account A with checking account B, and then just living your life like normal.
Right.
And that is so important, the psychological importance of having it be automated, and you don't have to change your habits at all, assuming you're already financially disciplined. We're assuming that. If you're
Right.
spending money like crazy, there's no financial strategy is going to work.
Nothing's going to work for you if you spend more than you make. So you're right. So if that piece of it, and that's particular to the product, not necessarily the strategy, right? But that the product that my boss, I can't take credit, I was here, but I didn't build it, that my boss built here. He built it in a way that completely aligns with the strategy. So we built it for people that want to use the strategy. And I believe I have one with us. I know it's convenient for me to say that, but it's true, right? And I chose it because I believe our product offers the highest value add for this particular strategy if you're going to use it, which is the automation. The reality is that somehow your money has to get in the HELOC. And somehow your money from the HELOC has to be used to pay for your daily expenses. If it's not built like that, here's what you have to do, right? You deposit money to your checking, and then you log in and you move money to the HELOC to get it there. And all the money's there now, right? Well, now you have to use it to pay for your bills. So you log back in and move money back to the checking account to be able to spend it. But transferring money is not that hard these days. We know that. But moving money for every single transaction that you're going to do, for every single haircut, every single gas station, every single grocery, every single utility bill for the next 7 years, and that's a pretty fast payoff, but 7 to 10 years is a huge burden. And what we find is that it's, for most people, it's too much of an expectation. It's too much of an upkeep for them to follow through with for that period of time. And so they quit. They stop doing it. And so when the numbers check out, right, when the numbers work and the budget works for this product, then the budget doesn't get in the way of people's success, right? We vet for that big time. So given that the numbers work out and the budget works for it, the main reason why people quit is if they have to manage that movement of funds. And so we wanted to offer something that didn't get in the way of people's success. And so the way it works here, again, is when you deposit to the checking account, it automatically moves the money into the HELOC for you, which is where you want it to go. And then the money's sitting in the HELOC, and then you've got a zero balance in the checking. Well, if you want to use your HELOC to pay for your bills, which is the second part of the strategy, you use the checking. Well, it does draw the balance into the negative. That happens. It's not an overdraft. There's no penalty. There's no fee. It's just a reflection of what you spent. And then that night, the sweep feature sees the negative balance in the checking, and it pulls money from the HELOC to reimburse the checking back to zero. Well, that increases your HELOC's balance by that exact amount, essentially paying for those things. So all in all, the reason why we built it that way is we wanted to build a product that aligned with the strategy. Again, it's all about the strategy, right? And so we wanted to build a product that lined up with the strategy in a way that the product wouldn't get in the way of people's success. Because here you just use a checking account the same way you would otherwise. So yeah,
Right.
that's it.
So it is about cash flow. It's not just about paying down your house more efficiently. That's part of it. It's you're replacing your checking account with a much more efficient cash flow management tool, namely this first lien HELOC. So now your income and everything is flowing through
Yep.
this more efficient tool. So the sort of vanilla, typical, no-brainer explanation is you can pay off your house more efficiently. As long as you have a housing payment, you may as well make it in the most effective manner possible. However, there are more advanced strategies, right? So
Can I stop you for a second, though?
Sure. Yeah.
Because those advanced strategies I definitely want to talk about, but there's something else too that I think is really important for us to name, right? Just like any product that's available in the marketplace, there are a myriad of different offerings that are available. In the mortgage world, there's an amortized mortgage and a first lien HELOC and then a second lien HELOC. Those are the ones I'm aware of right now. I'm sure there are other structures too, right? There's an ARM, 5/1 ARM, that kind of thing too. Each one of those has its own particular value added market that it appeals to and provides value to. And so I think it's important to name and know that the first lien HELOC is great for the right person. But it's not, you just get a HELOC and your home's paid off really fast, right? You mentioned cash flow earlier. Notice we haven't talked about rate yet, right? And there's a reason why, because rate doesn't really affect it that much, which is totally counterintuitive to what we know. But you've mentioned cash flow a number of times, and I kind of want to dig in on that a little bit, if that's okay. Because the only thing that ever makes this work is making more than you spend. The only way this ever works is living below your means, is being disciplined with your finances. If you're living for a household that lives month to month, this will not be a better option. It will not. You have to cash flow really well for this to work. Because if you think about it, we think about a household that does live month to month for whatever reason. Like here's the thing. There was a point in my life, a season of my life where I had 3 little kids and I was paying for daycare for all of them at the same time. I don't know if you have kids, but anyone out there who may be watching this, if you've ever had kids in daycare, it's like the most expensive thing you'll ever, incur. And so we didn't have extra money, right? We didn't cash flow. I didn't have a first lien HELOC, and that's not because we're irresponsible, right? It's just because our season of life, we didn't have more money than we spent. And so, I say that because everyone goes to the, you're, buying Starbucks all the time, or, you're responsible with your money. Cost of living for us met the income that we had. And so at that point in life, well, now things are different, right? And they're not in daycare. I'm not paying for that. And we've paid off our cars and that kind of thing. So we cash flow. So I have the tool now. But in that scenario, right, if you bring in $10,000 and that pays down your home loan, and then your lifestyle requires $10,000, you then take $10,000 out of your home loan to cover your lifestyle. Well, if you're at 300,000, you go down by 10 to 290 and up by 10 up to 300. That household will never pay off their house. That is the opposite of what we want, So it's important to know that this is not a fix-all for everybody, right? This isn't a hey, I just want to pay off my home, so I'm going to get a first lien HELOC and I'm going to pay it off. That it doesn't work that way, right? And I know I'm kind of going down a rabbit hole with this and spending extra time with it, but it's really important for people to know who this works for, right? And when it doesn't, because it can be dangerous when it doesn't work, right? It can be worse than an amortized mortgage. But the amazing outcomes that people are seeing, those households budget really well and they're disciplined with their finances and they live below their means because there's surplus at the end of the month. And the surplus is what pays down the house. So sorry to go down a sort of different direction, but I think that we can we can present anything in a perfect world, in a great scenario. The reality is that for the right person, this is absolutely amazing. But what I don't want to do is come across as someone who is only going to present the flowers and all that kind of stuff. It's like, look, this is what it is, right? This isn't a pitch for First Lien HELOC. This is an educational, hopefully opportunity for me to share what this is from a holistic standpoint as compared to just the positive aspects of it.
Yeah, this requires financial discipline. It requires positive cash flow. And I definitely think that the sort of person who's going to succeed with this is that type of a person. They are
Right.
on top of their finances.
Yep.
This is definitely requires more of the client in terms of understanding and financial discipline than a standard mortgage where it's just make your monthly payment and that's all you need to know. As long as you do that, at least you won't get foreclosed on, right?
That's right. And I think here in the States and with the amortized mortgage, but here in the States, I think the majority of homeowners, they calculate their fixed costs. So I've got my house. First, I've got my income, right? And from that, I've got my house payment. And then I've got my car payments, right? And then I've got these other fixed costs. And once I calculate that, that tells me what my budget is for what I can spend. And if that's how the budget planning is created, people are conditioned to spend everything they have access to, right? If you spend the rest, right, you got your fixed costs and what's the remainder, what's the money I have left, that's the amount of money that I can spend, right? We're not conditioning ourselves to create a budget that's based on an amount that we want to spend. We're forced to create that budget for ourselves. Well, that doesn't teach and condition people to live below their means. That teaches and conditions people to live at their means. And so I think that and again, there'll probably a lot of comments. Anthony, you're wrong. You're a liar. Stop judging us. And that's not the intent, for what it's worth, right? I do believe that that is a common way of budgeting, and to have a budget, the type of budget behavior that we see from a lot of Americans, or they're spending more than they've got.
Or they don't have a budget.
or
Budget
they
was
don't have a budget,
they don't
right?
know where their money is or where it's going.
Right. So if those are the categories that we're in, well, imagine if you have this vehicle that you can really spend whenever you want. There's nothing capping your spend. That could be the first lien HELOC. Well, now if we're conditioned to spend everything we want or we don't budget at all, you can condition yourself to very, very quickly start living a lifestyle that costs more than the income that you make. And now your balance on your home is going up because not only is there not a surplus, but now you're spending more than you make. So now the balance is increasing month over month. Well, that's a very, very dangerous place to be. We vet for that for what it's worth. So any person that we talk with, we run a decent budget analysis, and working with people like you, like, and obviously you do as well, and know about the behavior also, right? To vet, to make sure that the right people are being introduced to the concept, if that makes sense, and to the product and the strategy. But you know, that's one of the people ask, what's the catch? Well, my answer to them is, well, the catch is you. The catch is whether or not you can maintain the budget that we claim that's here, right? Or do you live below your means? Because that's the driver for this. There's nothing else. There's nothing else that makes this work, and there's nothing else that will ruin this either. And so it's important to understand that. So, you know, I'll bash the amortization schedule all day for my purposes, right? Of having people then ask, well, hey, well, what else is there? Like, oh, there's this first lien HELOC, and, you know, I get to ride in on the white horse, right? But that being said, the amortization schedule, like you just said before, it provides a guarantee that if you pay this every single month, your home will be paid off in 30 years or 15 years, 2010, whatever you choose, right? Guarantee. That security and that guarantee is really valuable to a lot of people, because all they have to do is figure out, this is all I have to pay and I'm still good, right? If that's the mindset, it's a little bit, it's different than what's required for success with the first lien HELOC, right? But if that's not your mindset, if you're like, look, I'm gonna make sure that I live below my means. This is my budget, even if I have $1 or $5 or $15,000, and that's a lot of money, but additional, my budget is this because that's what I've chosen to do, and whatever excess I have, is excess, and no matter what that is, this is my budget. If that's the mindset, that's the type of person, that's the type of mindset that really succeeds with this. I'd say it's probably 15 to 20% of all homeowners, to be honest.
Yeah. So then there's also, so some people just use this to pay off their house more quickly.
Right.
Some people use it more strategically, where they're not necessarily paying off their house, but they're strategically making use of the equity in their house. And
Yep.
I love the complementary strategies of using velocity banking with infinite banking, right? So you have this first lien HELOC that you're using, and then you're building up your banking system in specially designed cash value life insurance policies.
Right.
And I believe, if I'm not mistaken, Anthony, that's something that you personally do. And I love that strategy. So I wonder if you could
I do.
tell us a bit more about it, because maybe I'm flattering my audience here, but I think my audience is more sophisticated financially, more disciplined financially than the average person.
Fair
And
enough.
so
Yeah.
that sort of a strategy would appeal to them because they are disciplined enough and understand
So,
it to do. In fact, I also have clients who do it as well and have been very successful with it.
so could my role as a loan originator comes with a fair amount of, fair is an understatement, of federal regulation and compliance that I have to follow, that I have to be really careful with, if that makes sense. Because
Yeah.
I can't, I never, I'm not allowed to come across as a financial advisor, right? To advise people a certain route. Hopefully, so far, this has been the perception of this conversation so far is one that's an educational one, as compared to I'm telling you have to go get it. I'll teach this all day long. I'll push the education. I'll advocate for it. That doesn't bother me at all, because the numbers prove whether it makes sense. I will absolutely, I would love I will share my experience, but would you be okay sort of walking through a general idea of how you understand people can leverage their first lien HELOC. And then and that way I'm not presenting the whole concept, right? And the
Yeah,
person
yeah. So
is,
in general, um, what some people will do is they're running their cash flow through their first lien HELOC, doing the velocity banking strategy, and they'll just pay off their house a lot quicker. What other people will do is they'll strategically pay down their house, and then they'll periodically pull that equity back out to make some kind of a strategic investment or purchase of some kind. So some people will then draw that equity to go and buy a rental property, right?
yep,
Buy some sort of cash flowing investment such that the cash flow from that investment can pay back that then
yep,
can feed back into the HELOC, right?
and increase
Uh,
cash flow.
Right. And one
Yep.
of the things I like to do is using the HELOC to fund specially designed whole life insurance policies. Now, this is not a recommendation. I'm just saying this is something that I personally like, and
Yep.
I have clients who do it. I would never recommend anyone do this, but I would
100%.
explain this is an option which many people have successfully done. It does require a higher degree of financial discipline and
Yep.
financial acumen, right?
Perfect. That tees me up. Great. Thank you. That's wonderful. So you're right. So the idea, there are two kind of directions that people tend to go with the first lien HELOC. The easy one to present is pay off your house really fast. Right? That turns heads, you know, and you get the 5 to 7 year hook, and people you're like, what's that? This is weird. Everyone connects with paying down debt. Not everyone wants to become an investor or is an investor or wants to enter that world. So the reality is, because every dollar you put in here, you can take back out. As you pay down the home, you've put a lot of dollars in here. So you've got a lot of dollars you can take out. Or let's say you own a house that's worth 500,000, and your max line, your limit on this first lien HELOC is 450. Well, if you owe 200,000 on the house, that means you have from 200 up to 450 available. That's $250,000 that you could use if you want. Now, don't go on eBay and like buy a Lambo, but you could leverage it for a cash flow producing asset, which now you're improving your financial life. So, you know, taking the money out can seem counter to paying off your home really quick. And it is, right? It delays it. But it's not counter to financial best practice if you're smart with it, if you're prudent with your investments. And so if you're borrowing from the HELOC, the reality is it can give people access to more capital in terms of the equity than they would have access to otherwise, which doesn't mean you have to go invest. It doesn't mean you're supposed to, but it does mean that you have the option to think about, well, you know, what if I took 150,000 out and invested over here? I don't know anyone, and maybe I just don't run with the right people, but I don't know anyone that can do that for real, right? Unless you have some sort of vehicle like this, you know? And so it gives regular people the ability to ask those questions. Their cogs start to turn. You may not want to do it, right? But if you with an amortized mortgage that's locked away, you never have the ability to even think about that kind of stuff. So it just opens up opportunities. So one of those, you know, people talk about real estate investment a lot. There are alternatives to, you know, there's hard money, all that. Another investment tool that I've learned about over the past couple of years, it's really cool how there's an integration now that's starting to happen between velocity banking and the first lien HELOC and instant banking, right? Which is essentially leveraging a whole life insurance policy in a way that's alternative, that's different, but it leverages the way that the particular tool works. It leverages the rules of that financial vehicle for a purpose, a different purpose. And it's different than the traditional, I'm going to get my life insurance, I'm going to pay it and just keep all the money there. And then you know, when I die, I can either, you know, that my family gets a bunch of money. It works, it can accomplish that. But from what I understand, it can also, the way that it functions can function in a way where it can be a cash flow producing vehicle as well. And so what I've done is I've decided to max fund a life insurance policy from the equity of my home, right? Which is a lot. I'm just telling you, they're expensive. We know that. Like there's a huge barrier to entry because to get a whole life insurance policy that's really worth anything, you have to have a lot of capital. And that's the barrier to entry. Well, I use the equity of my home to do that. Well, the way that mine is structured and built um, allows for me to borrow the majority of the cash value back to wherever I want. Well, I put the money back in the HELOC, right? So now my HELOC's balance, and I can't take all of it, but it eventually, so I took the majority of it and put it back in the HELOC, which then pays my HELOC balance back down to pretty much where it was before. Well, now I've got this monster death benefit, right? And I'm not trying to, I hope it doesn't come across as me being arrogant. Like I say monster because I couldn't have gotten it otherwise. Like it's impossible, right? So this death benefit for my family that I couldn't have had otherwise, that is, this big amount, right? And then I take the money back out and put it in the HELOC. Well, next year I'll leverage the HELOC to pay the premium, right? So maybe you can help me with the language. I called it a
Yeah, you're
dump.
creating first of all, we're not talking about an investment here. That's important. If you pull from your HELOC and buy a rental property, that can be a great thing to do, but there is some risk involved, right? It's
Yep.
it's an investment. There's some
Right.
risk involved. Whole life insurance is a guaranteed asset. It can't have a down year. Your cash value cannot go down. Okay. So what you're doing is you're pulling from your HELOC to purchase a whole life policy. Then you can take out a policy loan against your whole life policy and pay down the HELOC, right? So you're using the bank's money to purchase your life insurance policy, and then you're using the insurance company's money to pay back the bank.
To pay
When you
back
take
the
out
bank.
right, and when you take out that policy loan, it's not a debt. There are no repayment terms whatsoever. Okay, so you have no debt left. Now it depends on how much you pool and how much you pay back, but now you have control, right? So what it allows you to do is to take out a much larger whole life policy than you otherwise would have been able to, right? Without having to do anything that's risky, right? That there's not a risk here because the asset you're purchasing is guaranteed and the policy loans are not a debt. They have no repayment terms. Okay. So there are,
So
I'll put in the video in the description below. There are some YouTube videos that show people who have used exactly this strategy, right? And I have clients who have successfully done this strategy and been able to take out much larger whole life policies, and it's phenomenal. It's Sebastian, who forget the name of his channel, but he's talked about it. He calls it infinite velocity, doing
hmm,
velocity banking with infinite banking. They're very complementary strategies,
yep.
and there's similarities between the two, right? So for the sort of people who are viewing my channel, I think they are great candidates for this because they tend to be people who have higher incomes, they have more financial discipline, they understand these concepts,
Right.
and they will be very successful with it. So I've seen my clients do all sorts of really cool things using both home equity and whole life insurance policies.
Right.
But
So
same thing applies. This is not for people who don't have financial discipline. This is not for people who are not willing to learn the strategy, right?
this
You have to
isn't for someone that
understand.
needs a way out. It's
Yeah,
not for
there's no
someone
free lunch.
who's,
There's no free
and
lunch here.
it's not a fix for if you're in trouble. This is not a fix for that. This is if you're already succeeding, if you're on the other side of things, right? And again, you're making more than you spend, you're financially disciplined. We can teach the concepts so you don't have to be the most knowledgeable in terms of structure and how to leverage, because we can teach those concepts to you so you understand and so you can control how they work, right? And that's my whole thing is, that instead of, give a man a fish, let's teach him how to fish, right? Because
Yep.
because I want you to control your future because this tool requires you to be in control of it.
Exactly. And that's so important what you just said, because what most um, financial professionals or products or strategies in the financial sector do is they don't teach you to fish. They deliberately say, give us your capital and we'll manage it for you.
Right.
So it's the opposite of giving people financial independence because now you're by definition dependent on whoever's managing your money for you.
Exactly. Well, I don't,
Right?
for one, like I think sometimes that's a play, we'll call it, to keep people on the hook, right? If I'm the one that knows this and my knowledge is proprietary and you don't get access to it, then I get to manage what you're doing. I don't want that responsibility. I don't. What I want to do is I want to teach this well so that every single person that decides to move forward with it understands how it works so well that they're not confused if it doesn't work, right? It's
This is
like,
why,
yeah,
yeah,
I spent too much. Like that's it, you know?
right. This is
But
why I'm so happy that I'm not a fiduciary.
yep,
I'm not telling you what's in your best interest. I'm not telling you what to do. The only one who can decide what's in your best interest is you, Mr. Client. You
yep,
take responsibility for your decisions. I'm here to coach, advise, design it, educate. I want to empower you to succeed, but
yep,
you have to be the one to do this. I'm like a good fitness coach.
yep,
You have to do the work. And if you don't want to take control of your capital, which sadly most people don't, then this is not for you. Velocity
right,
banking, infinite banking, these strategies are not for you. If
yep,
you don't want to take control of your capital, if you don't want to control your finances, if that's just a headache to you and you'd rather let somebody else manage it, these are not the right strategies for you.
right,
These are
yep.
not the right ones. Then you
But
should
it,
take out a conventional mortgage and give your money into a 401k or standard financial advisor and let them manage it for you.
yep.
So
Do
I'm
that,
not
and then
knocking them. The reason why those exist is because there is a demand for it, right? There are people who don't want to deal with that. And if that's you, then that's probably a better strategy.
well, and I don't know about how sensitive the channel is to bring up other people, but Dave Ramsey doesn't like this concept. He doesn't like what we do, and he also doesn't like whole life policies either.
Right.
But in terms of, but what he does is he makes assumptions that aren't true for everybody, right?
Mhm.
His assumption that he makes is if you get a HELOC, you will overspend and you will become irresponsible and your balance will go up and you'll never pay off the house. Well, you know what? For his audience that need to listen to him, I agree with that. If you
Yeah,
need,
no, I would not. Yeah. I would
right?
not recommend this for his
If you
typical
need
listener.
Dave Ramsey, then he's right. He's
Yeah,
completely right. But here's
absolutely.
which means even from an ethical standpoint, he can't vouch for this because all he has to do is open the window a little bit, and a fifth, or sorry, like 5% of his people would try it and fail, and that's
Yeah,
true, right?
right.
But there are people out there that are financially disciplined, and just getting a first lien HELOC will not make you irresponsible. That to me is the complete fallacy in his whole argument, where it's like, okay, like, look, here's the thing: if you are disciplined, if you do live below your means, that behavior, that habit, that routine, that doesn't go away. That's how you function. And so if that's how you function, then just getting a first lien HELOC just means you're choosing a tool that better aligns with the way that you work already. And so that's awesome. And I mean, that the alignment between velocity banking and infinite banking to me is pretty amazing. Um, what what the way that some um, well, the way that my policy happens to function. Here we go. This is good. This is better. Um, is it's a certain amount of premium, right? And I can borrow from the general fund. I'm not actually borrowing from the cash value, but I'm borrowing from the general fund from the insurance company. That's the way I like to think of it, right? Because
Mhm.
my cash value stays the same. My whole
Yep.
cash value that's created never gets changed.
You're
And that,
borrowing against your policy. You're not borrowing from your policy.
right.
Correct.
And so the cash value stays at the full value, which means that continues to generate interest. The first year, I can't take all of it back out, right? So take some of it back out, put it in the HELOC. The next year, I pull from the HELOC to fund the policy. I can't take all of it back out. So I put, 90% of it back in the HELOC. Well, on the third year for my particular scenario, and again, from what I understand, everything about your history and your health, thing that you do, I got an EKG, and they took blood samples, all that kind of stuff, right? All of that, from what I understand, once the underwriting is done, compiles and creates the offering that you receive for this life insurance policy, right? So it's particular to my scenario, right? But my scenario on year 3, I fund the policy and I can take out I can borrow $1,000 more than I put into the policy, right? The next year I fund the policy and I borrow $4,000 more than I put in the policy. And it only increases year over year over year over year. Well, that starts to even more aggressively pay down my first lien HELOC each year. Well, one argument that's made is that, well, you're not paying your life insurance policy back, right? And it's not free money, like it offsets the death benefit in case you pass away, right? Which is a valid argument for, again, this is my particular scenario, right? This isn't how it works. I don't know how it works because I'm not in that, but in terms of my particular.
Right. But the question they're not asking is as compared to what? This is
As
a
compared
death
to what?
benefit you would not have had otherwise, right?
Well, and here's the thing. It does offset the death benefit in case I die. My death benefit, again, I'm not trying to be arrogant. Because I was able to fund it with so much money, I created my death benefit that I received is so great that if I borrow $500,000 from against my my cash value, it doesn't matter because the death benefit that was created is so great, it doesn't matter to me, right?
Right.
That
There's
may
still
not be the
plenty,
case for
still
other
plenty
people.
to protect your family. Yeah.
Right. And here's the thing. If I borrow, if the cash value wasn't, sorry, if the death benefit wasn't that great, right? If it wasn't that big, then, and I borrowed a lot and I had to offset that, then it would be a completely different scenario, right? And it would be terrible. And I wouldn't have chosen to do that, right?
But based on what I know of whole life policy mechanics, that's probably not possible.
So I don't know that.
Just
I
because the way
don't know how it works.
because of the way actuarial math works, unless you're a very old person, that probably can't happen because the death benefit is going to have to be significantly higher, just the way that it works. So
That's fair. And
describing
and
is
again, like I don't, I'm glad that
practically speaking impossible.
right. So
At
I,
least in the early years, like later on, the
later
cash
on,
value
it's harder.
starts to catch up more to the death benefit. Just that corridor starts to close some.
Got it.
But yeah,
So yeah, I mean, like that's my experience and that's my strategy right now. At this
love
point in
I
time,
love that strategy.
it right now, it makes more sense for me to store the funds in the HELOC instead of in the life, instead of the policy. So
Right,
because
and you can do either. That's the beautiful thing.
you do
You can
either,
do back
you
and
could,
forth, wherever you want to store your capital, and it's probably both. It's not an either or. You're probably gonna have some in the HELOC, some in the whole life policy, and you can
right?
decide what makes the most sense. Maybe if interest rates change, dividends change, you can do what's
Yep,
advantageous to you, and so now you are in control.
100%.
And so that's that. I'm glad to hear that's been a phenomenal experience for you. I have clients who do exactly the same thing. It's been a
Yeah,
phenomenal experience for them. They love it. They've been able to take out much larger whole life policies, and it's been phenomenal.
it's great.
Um, so, and to I want to hear more about some of your client success stories, even if it's just simply paying off their house faster. I've seen some of the ones you posted on social media, but this obviously we're going to give direct evidence that Dave Ramsey's assumptions are not correct, at least about certain people, right?
Yeah, yeah. So the one of the campaigns we did was to sort of survey our clients and ask them if they'd want to share success stories. And I mean, I'm like salivating at the mouth because it's like this is everything comes circle, right? And for me, again, like that's what drives me. Knowing that my work gets to improve people's lives is what drives me. And so I was able to talk with a few people and ask them and kind of interview them about their experience with it and hear the impact that the First Lien HELOC had. Now, did I do that for them? No, they did it, right? But I like to think that there was some sort of education or some sort of value in terms of understanding how to work this that maybe I had an influence on, maybe I didn't, right? But all I know is that I felt like, to me, it was like a complete circle in terms of we teach what this is, we say that it can do these things, right? And logically and mathematically, it's true, right? But then it's like, well, what happens with all the customers? Well, if people are happy, they don't talk to you anymore. They're not calling you all the time, right? It's like crickets, right? Because people only call you when they're mad, right? And so if they get what they expect, right, then they're on their path, and that's what we want, right? But was able to talk with people. So, you know, one was able, you know, she was a mother of, you know, a few kids, and she received an inheritance, and she was able to pay off her home with everything. But what she said is she wouldn't have been able to, able isn't the right word. She wouldn't have taken that action otherwise, because the money would have been locked away in an amortized mortgage because it's
Exactly.
closed-ended. And so she wouldn't have, she would have done something else with it. That probably would have been a
Exactly.
good move, right? She may have paid down the house, but here's the thing. If you pay down your house, if you pay off half your mortgage with an amortized mortgage, you're still paying the same payment. It doesn't change your payment. It does change the effectiveness of that payment, but it doesn't help you from a cash flow standpoint. So what she was able to do is completely eradicate her housing expense, uh, while still retaining liquidity of those funds that she put in there in case she needs it. So now she's got this like $300,000 line of credit that she can fall back on if an emergency happens, but she's not paying interest on the home because her balance is at zero, right? Like that was, now that's a pretty extreme scenario. Not everyone receives inheritance or even enough to do much with, but that was one example that stuck out to me.
Yeah. Yep.
You know,
That's a great one because again, people, you're right. I think if I got a big inheritance and I had an amortized mortgage, I don't think it would be smart to dump all that into the house because now I've lost access to all that capital. It's gone.
right,
I can't touch it anymore. Whereas when you pay off your HELOC, you still have access to your capital. And I
right,
see this myself. So me, given the situation that I'm in, I sometimes play around with debt instruments more than I otherwise would because I feel like I need to know about it and tell my clients about it so they know what's available to them.
right.
And so I've taken out a couple of personal loans on very favorable terms, and got some good incentives for doing it. And even though I could have paid them off anytime I wanted to, I decided not to, and I just kept making those normal payments because if I pay them off, I don't have access to that money anymore.
You have access to the money.
Whereas with my HELOC, I pay it off and I can pull that money right back out if I want to. So there's no problem paying off the HELOC. I still have access to the capital.
Yep.
Right?
And that concept is what sometimes people struggle with, that because in reality, you know, if we kind of go back to the strategy here, all of your surplus is just basically being funneled into your home loan. And so people will ask, well, couldn't you just do this with your mortgage and take all of your money at the end of the month and funnel it into your mortgage, your amortized mortgage? And wouldn't it be better because the rate is lower? And my answer to them is yes, you're completely correct. Mathematically, you're completely correct. However, I'll go a step further, right? Let's pretend you, person who comes up to me with a question, right? Let's pretend you're a financial planner and someone comes to you and says, hey, I found a way to really pay off my home really fast. I'm going to take all my money at the end of the month, all my surplus, and all of it's going to go into my mortgage. And it's locked away and I can never take it back out, right? And I'll ask them, so let's say someone comes to you and you're a financial planner. Would you call that, would that be a amazing idea, financially neutral, or a terrible idea? If we had to choose one of those buckets, right? Which bucket will we choose, right? Well, I'd argue it's pretty terrible advice to put all your surplus into a place that you can't take it back out. And so the reality is we don't function as like debt reduction robots that there's nothing else going on in the world. I mean, we're human beings. We need to have surplus. And if you don't believe that, then you should be putting all your money into your amortized mortgage, right? Because that's the best thing to do, right? But that's not feasible. It's not safe. It's a really, really, really dangerous idea because you have to have some sort of surplus. So what this allows for you to do is safely do that. You can safely put everything in here because you can take it back out if you need it, which means that it's liquid and it's not locked away. So you still have access to that surplus while all of it's being serving as a debt reduction purpose, right?
That's such a phenomenal point. I love what you said about us not being debt reduction robots, because there is a huge psychological component to this. And there are huge intangible benefits to both infinite banking and velocity banking that I think it's really hard for people to appreciate until they start doing it. What value is there to having access to capital that now a huge portion of your home's value is liquid and available to you for whatever emergencies, investments, right? Just having that and the peace of mind to know, hey, I got $300,000 I can tap if I need.
Right.
That makes you so much better at managing everything else in your financial arena. Same thing with the whole life policy. I've got this guaranteed asset that's growing tax free, that's protecting my family with the death benefit. I can borrow against it on the most favorable terms known to man. I now have access to capital in the two best places where I can get the best possible terms: my primary home and my whole life policy, right?
Yep.
And so that kind of ties into my final question for you, which is that, because for me, I know a lot of people get caught up in the numbers, and the numbers can look amazing. Don't get me wrong; like the numbers are phenomenal.
Right.
Um, but as your understanding evolves, as my understanding of this and experience has evolved, I now emphasize more the intangible benefits of having control over your capital, having protection, having liquidity, having access to capital on such favorable terms. So, how has your understanding of these strategies evolved over time with experience and with seeing your clients experience?
So my my progression was pretty similar to I think most people's, where the first thing you learn, sorry, my phone's ringing. The the first thing that I um understood was that what was the aggressive payoff piece, right? So it's like, sweet, we're going to become debt free. This can do that. I'm going to do that, right? Traditional American dream: become debt free, pay off your house. Um, and then I understood more about, as I learned more about different ways to use this and leverage capital debt. Now it becomes an investment tool. The velocity banking projection still needs to work if you're going to leverage this. So let's not say that they're mutually exclusive, where you can be irresponsible with your funds and then it's okay to leverage this. That's not the case, right? So they both have to work. You have to be disciplined, and then the next progression of development, we'll call it, is one where you leverage to then pay off the house really fast, even faster, right? The integration between velocity banking and infinite banking is another thing that I've learned recently, because I don't necessarily see infinite using the First Lien HELOC with infinite banking as an investment. I see it as a way to create an amazing financial tool along with doing this, right? So that's another piece. Yeah, both are kind of cash flow driven. So if people aren't open to trying to understand how they could integrate, you could see them as being competitive. So I think for a long time, they were seen as these two competitive cash flow tools, where I have to have the cash flow for this, or I have to have the cash flow for this. The more that people talk and share about how they both work, it's like, wait a minute, there's opportunity here for these to work together, which I think is amazing. I think people are becoming more open to that. The reality is, if you are a good fit for a First Lien HELOC, chances are you'll be, well, I believe it's a very, very overlapping target market, right? Or people that can provide value, because, they require the same thing. It requires a pretty high level of financial discipline for both. So it's like, people who see value in one can see value in the other. I think that the main thing the place that I'm getting to now is one of, my goal is not to pay off my house. I don't like in terms of progression and mindset and what I want to accomplish. I don't care if I'm in debt. And that's counter to a lot of the philosophies that people have. But this is me, right? And this, again, this is not the right way to go, but in terms of my progression, if I can find investments that produce cash flow for the remainder of time, we'll go ideal, right? If I can find investments that can provide cash flow for the remainder of time to provide security for my family that can support us forever, right? And have debt on the side, that doesn't bother me. That may bother a lot of people, and that's okay if it does, right? And don't do what I'm doing if it does, right? But in terms of my progression, it's like, if I can create enough cash flow with those investments that offsets the debt payment, and they're either appreciating assets that also cash flow well enough to cover all the debt, debt servicing that I need, and to be able to provide for my family's short-term and long-term needs, and provide enough surplus where I can take more and invest later on. That's the ideal. And if that means that I leverage debt to be able to accomplish that faster, then I don't care about the debt. And so, and I'm not saying I'm leveraging all my HELOC. No way, no way, no way, right? I have I've got it's really more like 10 months. I've got 10 months surplus, or 10 months emergency fund, right? To cover my family. And I don't touch that with my first lien HELOC. But everything else, I'll leverage that, and I'll leverage that for the remainder of time if it can result in cash flow producing assets that fund and support our family. And so, in terms of progression, that's kind of where I've ended up, at least now.
Yep. Yeah,
So
debt freedom does not equal financial freedom. If you want to be debt free, I agree with you. That's totally fine. I know people who just hate debt and don't want it. That's fine. That if that's your philosophy on life, go for it.
yep.
And certainly, it's safer to be debt free than to have debt, obviously. But debt utilized properly, strategically, responsibly, can be a good tool because to me, it's not about debt; it's about cash flow, right? So if
It's
you
about
can
cash
use
flow.
that to create more positive cash flow in the long run and put yourself in a safer position, right? Because
I
someone who
agree.
has $300,000 in the bank and a $300,000 mortgage, okay, if you take that $300,000 in the bank and that's all the money you have and pay off your mortgage, you're now in a much riskier situation. Okay, you're debt free, but now you have no emergency savings, right? You have
Right.
nothing to fall back on,
Right.
right?
In case something happens, you've got, like, I know that I need to have a certain amount for my family so that we can fall back on it. Because I've been in a place where we didn't have enough money. I've been there, and I know what that does. And again, it may not do this. I know what it does to me mentally, as a father, as a husband, right? As a employee, a worker, all that kind of stuff. And so, being productive. So I promised myself I'd never go back there. And if that means that I create a monster emergency fund, then that's what we do, right? And that's what we've done. And so, yeah, I mean, I think there's the traditional, what I like to call it, the traditional American dream of we pay off our house and retire and we're happy. That works. That can work if you've got a nice pension, which are going away, right? So now you're reliant on your 401k, your IRAs, to fund your retirement along with Social Security, which isn't some monster pension that you just fall back on. It's not some guarantee that you receive every single month. That's actually a pretty decent amount. Those are not as available as they were before, as government entities. My wife's a teacher, like, she's on 401k now. So there's no, the teacher retirement system is now a 401k IRA one instead of a pension, or they've got like a hybrid. So it's not like the highest year of the highest 4 years of your income, you'll get 75% of that for the rest of your life. That's not a thing you can fall back on anymore. So the idea of controlling your finances and controlling your financial future is becoming more and more important because the guaranteed income that used to be available with those structures is just not as common anymore. And so that's another one where the life insurance policy, if it needs to be, can serve some of that function for my family, right? Just by the way it works. In terms of investments and leveraging capital, right? In ways that are smart with, cash flowing producing assets, but also appreciating assets. Reality is, if I'm leveraging a bunch of debt and I've bought appreciating assets, if I get in a pinch, I got to sell an asset. I've made money on that and I put it in the HELOC to pay it down. So again, that type of move and that type of play is one that's smart because if you're leveraging the HELOC or capital to buy assets that are liquid in a way, right? Then the debt is kind of a non-factor. You just, and so anyway, yeah, it's the myriad of possibilities is amazing. It's just, being smart with it. And again, like what you specialize in, with the infinite banking concept and what I specialize in with the velocity banking concept, they're all in all, they're just financial vehicles that we know follow certain parameters and certain rules. So then the question is, what do you want to achieve? And if you want to achieve that, can what you offer help you achieve that faster or better? Or can what I offer help you achieve that faster or better? And if you can, then sweet, then maybe it makes sense. If it doesn't help you achieve what you're trying to do, then you don't get it. And that's kind of the way I feel about it. So
Yeah, yeah. Well, Anthony, thank you so much for your time. Great learning more
yeah,
about
Logan.
First Lien HELOC. And we will include some links in the description below explaining more about some of the things we talked about, particularly the strategy of using velocity banking with infinite banking, using HELOC to fund a whole life policy.
Definitely.
And we hope we'll have Anthony back on the show at some point in the future. Thanks so much for your time, Anthony. We greatly
Awesome.
appreciate it.
Dude, thanks, Logan. Appreciate it too.